Welcome to GRE. I'm your host, Keith Weinhold. There are myriad misunderstandings about mortgages. I dispel the myths and discuss the expected mortgage rate level in 2030. You will know more about mortgages than 99% of people today on Get Rich Education. You know Mid-South Homebuyers, that top Memphis turnkey provider. I learned that a secret weapon behind their explosive growth is more than just you buying their properties. It's an executive coach. For 9 years now, their CEO Terry Kerr and his COO Pat Nix have worked privately with a coach who I've now learned from too, and he doesn't market himself online anywhere. After 12 years behind the scenes, that coach is now making himself available exclusively for GRE listeners. His name is Daniel Thomas Hind. If you're a hard-charging business owner or investor who wants to get in the best shape of your life, physically, mentally, and professionally, you can fill out an application for a free consult. This is private one-on-one coaching for those willing to go to uncommon lengths to achieve uncommon results. Thanks to Daniel, we've all become better leaders, better operators, and better men. It started by showing up for ourselves. Now it's your turn. Go to danielthomashind.com, H-I-N-D, that's danielthomashind.com, and sign up before spots fill. What if you got your mortgage loans the same place I get mine? You sure can at Ridge Lending Group, NMLS 42056. They provided GRE listeners with more loans than anyone because Ridge specializes in investment property. They'll help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat directly with President Chaley Ridge. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. Flock Homes helps multifamily owners exit the operator grind, whether it's your sixplex or a 50-unit apartment, through a 721 exchange. This defers your capital gains tax. It's a strategy long used by institutions. Now you can swap tenants and toilets for passive income and zero management. Request your initial valuation. See if your property qualifies at flockhomes.com/GRE. That's FLOCKhomes.com/GRE.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Keene, New Hampshire to Kenai, Alaska, and across 188 nations worldwide. I'm Keith Weinhold, and you're listening to Get Rich Education. Everybody knows that a mortgage rate is the interest rate that a borrower pays on a property loan. Okay, sure, that part is easy. And then, oh boy, the misunderstandings begin about 8 seconds later. Where will mortgage rates be in 2030? I want to tell you about this and more because mortgage rates are one of the most talked about parts of real estate, and people discuss them with this confidence and bravado of a guy at a semi-quincentennial barbecue that's explaining crypto and nutrition between bites of potato salad. Yet he's probably got a lot of things wrong. In the next few minutes, though, you're going to know more about mortgages than 99% of Americans. Let me tell you about 5 Goliath mortgage myths that throw a lot of people off, and this includes what mortgage rates are going to be both next year and in 2030. The first myth is that mortgage rates are high today. I almost can't believe the number of people that say this. In the world that I'm in, I hear it almost every day. The reality is that mortgage rates have normalized. The 30-year rate is currently normal to low. Now, I shared with you before that the long-term average is 7.7% per Freddie Mac. They have the best, most respected stat set on historic mortgage rates, and theirs go back to 1971. Well, today's rate is between 6 and 7%. They just don't feel low after the freakishly low era about 5 years ago. Now, after I tell you about mortgage rates in 2030, I'll tell you also about whether we're ever going to go back to those 3% mortgage times. Understand, it's not just mortgages, but most other interest rate types are also on the low side today. A lot of rate types are based on the effective federal funds rate. What's based off of that are rates for credit cards, HELOCs, some business loans, and personal loans. They are all based on the prime rate, which is based off of the federal funds rate. Well, the federal funds rate's long-term average is 4.6%. Do you know where they're at today? 3.6%. So the Fed rate is fully 1% below the long-run average. The second myth, gosh, and this is such a pervasive one too, is that when mortgage rates rise, home prices fall. This is such a myth. And because I've talked about this premise before, let me bring some fresh angles to it for you today with some historical accounts too. Because the reality is that when mortgage rates rise, home prices usually rise right along with them, but sharply rising rates can slow appreciation. And before we move on, one of the most famous, I suppose, American real estate investors ever, he spoke about mortgage rates recently. Let's see what he says. This is under a minute in length. Oh, and he also happens to be the current White House occupant.
I made billions of dollars with housing. I know housing better than anybody, maybe anywhere. It's all about the interest rate. Lower the interest rates, you can have all the housing you want. But you have to understand, I don't want to hurt people that own houses too. These people, for the first time in their lives, they have valuable houses. They become rich. I don't want to hurt them either. What you want to do is what good for everyone. Get the interest rates down. We have this numbskull that was the head of the Fed before, and he's a stupid person, and we call him too late because he was too late with the interest rates all the time. We need low interest rates. Low interest rates will solve everything. We'll solve that.
Well, lower interest rates don't solve the main problem, though. We need to build more housing. Now, other than the fact that low rates could make it a little easier for builders to finance their operations, lower mortgage rates do nothing to increase the housing supply. And contrary to what most people think, rates have exceedingly little to do with home prices. When mortgage rates blew past 18% in 1981, they were between 18.5% and 19% then. What do you think that home prices did? Well, they kept on rising right through it. Since 1994, mortgage rates rose 1% or more 6 different times, and home prices went up all 6 times. Even when mortgage rates tripled 3 years ago, home prices still climbed on a nominal basis. How do they do that? Well, the short version here is that we've got to think about what's happening in the larger economy when rates rise. What does that mean? What does that signal? What is that a symptom of? Rates rise to keep a hot economy from overheating. And when the economy is hot like this, that usually means people are employed and they're confident and they're financially flush. So then what do they want to do? They want to buy a home, and therefore there are more bidders. That's why higher rates usually lead to higher home prices. And they're talking about raising rates again because employment has been resilient and inflation is more than double the Fed target. All right, well, if higher rates usually correlate with higher home prices, then do lower rates mean lower home prices? No, because nominally home prices rarely fall at all. Now, what then did rates do when real estate prices had a rare national fall in those years around the 2008 global financial crisis? Do you know what mortgage rates did then? Do you think that mortgage rates were up or down during the global financial crisis? And this is a definitive answer. There's no gray area. They were clearly either boldly up or boldly down. What do you think? During the global financial crisis, mortgage rates plummeted more than 2%. So the only time since the Great Depression that national home prices fell substantially, mortgage rates also fell substantially. The problem in that era, around 2008, is that you often could not get a loan. Banks were barely lending then. People overlook this. You can't just assume that you can get a loan whenever you want it, even if you qualify. But yeah, it's just amazing how many people believe this, I guess, second myth. I mean, it is one of real estate's most persistent fairy tales that when mortgage rates rise, home prices fall. That just doesn't happen. And gosh, it feels like I explain this to somebody every week, that when mortgage rates rise, home prices usually do too. If you explain this phenomenon to somebody, I think what you can tell them is that history shows, and as I like to say, take history over hunches, history shows that mortgage rates don't have much to do with home prices. The, I guess, third mortgage myth out of 5 is that the Fed sets mortgage rates. The reality is that they don't. And you probably already knew about this one because you're unusually sharp and you're listening to this. Mortgage rates are more closely tied to the 10-year Treasury yield and inflation expectations and bond market demand and lender spreads and the appetite from investors for mortgage-backed securities and even your credit score. That's what mortgage rates are tied to. The fourth one here is that you should wait for mortgage rates to fall before buying. And the reality is that maybe you should, but usually not. And again, we can look at history here. Almost every time you look back at when you purchased property and how much property you owned, when you added it into your portfolio there, do you ever think, oh gosh, I sure would have been better off had I waited 2 years? Now, if you do wait 2 years, what happens? Prices will almost certainly be higher, and you don't know where mortgage rates are going to be. Run the numbers, and you'll probably see that waiting is not the free lunch that some people think it is. The main problem with waiting is that it delays how the real wealth gets created from the 5 ways real estate pays. And to my earlier point, if you do wait, you're probably still going to be able to get a loan, but mortgage markets can seize up in times of distress, and you might not be able to get a loan at all. A lot of people just assume the credit is always going to be available. We don't know that for sure. Now, let's take a look at my most ill-timed real estate purchase ever, since we're talking about timing. And this is when I bought a green fourplex building in May of 2007, right on the precipice, just as we were about to tilt in to the global financial crisis. I paid $530,000 for this property. It was pretty nice, like not a beautiful building, but just a good setup where every tenant had their own attached one-car garage in that building. Okay, so I did not wait. And by the way, this was a big purchase for me at the time. I mean, $530K, perhaps that's about a $1 million purchase in today's inflation-adjusted terms. Back at that time, that was my biggest property yet until I got into larger apartment buildings and other single-family homes and things like that. But what happened just after I bought this in 2007? Well, that green fourplex's value temporarily went down. And during this time, I was paid the other 4 ways that real estate pays. Rates fell during the global financial crisis, so I had a refinance opportunity. And then that green fourplex's value had fully recovered by about 2012 or 2013, and it paid me positive cash flow every single month that entire time. And that's it. That was actually my worst timed purchase ever. That scenario, the worst mortgage conditions in anyone's lifetime, and it still wasn't so bad. Well, here's what else happens with the strategy of waiting for rates to fall. When rates fall, more buyers tend to rush in. And because you've got more buyers that qualify for a mortgage that didn't qualify previously, that means more competition. There are fewer seller concessions, if any, and there are higher prices. It might even create bidding wars, somewhat like we had in 2021. The last of the mortgage myths is that mortgage rates can be predicted, so you had better pay close attention to forecasts. Oh no. The reality is that trying to predict mortgage rates is about as predictable as to whether your contractor is actually coming on Tuesday. Let me tell you, all right, what the prominent analysts and agencies have to say about the future of mortgage rates. Amalgamating forecasts from Fannie Mae, Wells Fargo, the Mortgage Bankers Association, a Reuters poll of economists, and more, by the end of next year, okay, so about 18 months away, they all cluster in a range of 6.2 to 6.5%. This is for the 30-year fixed rate mortgage by the end of next year. And for 2030, it is about 5.8%. That's what we're looking at for crystal balls of all these agencies if you average them together. And you know what I have to say about these numbers? Don't count on these at all. These people do not know. Nobody does. They'll probably even tell you that they don't know. Okay, they are your forecasts right there. And what about us? Here, GRE does not make mortgage rate forecasts. We only make a home price appreciation forecast annually, and we are not about to make mortgage rate forecasts here. That is because they're just really hard to predict, and therefore that would not serve you. It's really just a form of entertainment that's a poor use of your time. It doesn't serve you. Making a bold mortgage rate prediction is exactly how economists audition for humiliation. Mortgage rates' future direction, that's based on so many factors like inflation, jobs, treasury yields, deficits, geopolitics, oil prices, and wars. And the future direction of mortgage rates has to do with investor sentiment, which often changes and often doesn't make sense, and whatever new, fresh economic surprise is going to wander in tomorrow. And, I'll tell you, when I was a pretty new real estate investor and I had a property under contract, I remember sometimes asking my mortgage loan officer over the phone, now, do you think that mortgage rates are going to be lower next week? Because maybe then I should wait and lock in. I mean, that's a question I asked a number of times. I mean, sheesh, it would have been just as useful if they answered by reading me their horoscope. Now, that is not a knock on mortgage loan officers in any way. They're smart people, but they just know that borrowers do want some insight, but it's just so hard to forecast. Now that you know that most forecasts base around 5% mortgage rates in 2030, which is useless information, will rates ever be 3% again like they were about 5 years ago? There is no forecast by any of these agencies that predicts a 3% mortgage rate at all in the next 5 years. But, really you have to ask, who saw that there would be such low home loan rates on the horizon back in 2007? And things like the Great Recession and a global pandemic, those sort of black swan events, they're just rarely, if ever, on the radar. And see, drastic events like that are what it takes to move mortgage rates down into the cellar. But a couple things are for sure. 3% mortgage rates anytime soon are extremely unlikely, and if that does happen, it probably means that there has been a real world calamity. Okay, that's what I can tell you. I've got more to tell you here, but to summarize what you've learned so far today, in this era, rates of all types are historically a little low. Contrary to popular belief, mortgage rates have little to do with home prices. Waiting for rates to fall rarely works, and mortgage rates are nearly impossible to predict. And my favorite way to make it easy for you to remember how interest rates move in an economy is that they are like walls. A high interest rate is like a high wall. It's an impediment to the movement of money because people are less likely to borrow and more likely to save, since savings accounts yield more. And then a low interest rate is like a low wall that you can easily just step over. It facilitates the movement of money, making you more likely to borrow and less likely to save. And if you want to understand more about how interest rates move economies and affect real estate, and you like analogies like that, I discuss more about how interest rates are like money walls in the latter portion of GRE episode 573. I've got so much more for you today. Straight ahead, I'm Keith Weinhold. You're listening to Get Rich Education. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio, through a 721 exchange. Deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's flockhomes.com/GRE. Let me ask you something. If you've worked hard to build wealth, is your money positioned to actually support your goals? A lot of accredited investors leave capital sitting in cash because it feels safe, but inflation and missed income opportunities can quietly erode its value. Freedom Family Investments offers Freedom Notes for investors seeking structured income backed by real estate. It's a straightforward approach built on real assets, not speculation. And full disclosure, I'm an investor myself. What I like is that their team walks you through how it all works so you can decide if it aligns with your portfolio and income goals. Every investment carries risk and nothing is guaranteed, but with a track record of consistent on-time investor payouts, they've built real credibility. Go to freedomfamilyinvestments.com to book a clarity call or text FAMILY to 66866. That's FAMILY to 66866.
This is Rich Dad Advisor Tom Wheelwright. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold, and let me help you with a couple questions that some of you have had. And when listeners or followers like you engage with us, whether that's through our general inbox or our investment coaching or even my face-to-face interactions with people, sometimes I hear something like, hey, well, I am waiting for the crash until I build my real estate portfolio. Now, I don't know how to take this always. Sometimes I think people are joking. Other times I actually think that they are serious. And see, what happens is that an awful lot of media creators, they will produce a video or a blog or a podcast, and they like to talk about how a housing crash is imminent because that type of material really gets attention. Words like crash and collapse, they're hype words. And these hype words like crash and collapse, they really play on people's very real primordial survival instincts that are produced in your brain's amygdala. That's why people keep consuming them. And it's also why fear-producing media gets lots of attention. I mean, it's the if it bleeds, it leads phenomenon. You know, in fact, I have one real estate pro friend, and he's told me that if instead of talking about real estate logically and with an education bent in the way that I do here at GRE, well, instead, if I flip that and I talk about doom and all the improbably bad things that could happen, that could make my material so interesting that it would create a following so big that would transcend real estate circles, and I'd be a regular on whatever, CNBC and the Joe Rogan show. This friend somewhat jokingly suggested that with the way I use the prefrontal cortex to discuss real estate, I should speak from the amygdala instead. I could become a doomer, a crashaholic, an appreciation denier. And by the way, the prefrontal cortex is the sort of executive brain. It helps you think things through, compare options, solve problems, make plans. Ask yourself the question, is this actually a good idea logically? It's the logical part of the brain. Oppositely, the amygdala, that's what tells you something feels dangerous, I better react now. And your prefrontal cortex tells you, hold on, let's think this through. It's what's logical. And, though this is what we've always done here, the logical, because scaring you is not serving you, it's only entertaining you. In fact, lately, there are even some people that were calling for a home price decline that no longer are doing so. And the NAR just revised their home price appreciation forecast this year up to 4%. And then the other piece is that I've received more feedback recently from listeners about something that you're trying to grasp, and that is the concept of inflation profiting on your debt, which I've always presented as the fifth of 5 ways that you're simultaneously paid through real estate. And really, the feedback, it goes something like this. I don't see where I'm profiting at all. If I borrow $100K on a mortgage, and then 10 years later, I still owe $100K because I still owe $100K. So how is this getting me ahead, even if the tenant pays all the interest? Really, that's the question. And before I answer that, you can always reach out to us at our general inbox at getricheducation.com/contact. How do you contact us? getricheducation.com/contact, where we have a real human being here at GRE monitoring the inbox for you. And oftentimes we also get comments on our videos at the Get Rich Education YouTube channel, so that's a less formal feedback mechanism. But if you're trying to grasp inflation profiting, think of it through the opposite lens. What if you put $100K in cash under the mattress, you slid it under there, and you left it there for 10 years, and then you unearthed it? Well, you probably wouldn't want to do that. Why not? It's still $100K. We all know full well that because at 3% inflation over 10 years, it will get worn down to about $74K of purchasing power since prices and rents and everything else is now higher. Well, in a similar way, $100K in debt after 10 years is still $100K, same name, but it will only have $74K in real value. That is the way to think of it. The saver lost purchasing power, the borrower gained repayment power. Hopefully, those two persistent questions about a housing crash and about inflation profiting gave you some satisfying answers. And anymore, so much of what we've discussed with you here every week since 2014, it is now in view. Or actually, it's not even in view as much as you are living inside it. That hollowing out of the middle class represented by the K-shaped economy. We are living in it. And when I told you about it, perhaps a decade ago, I was not using that term, K-shaped economy. However, that term was born in 2020, and it was popularized on Twitter back then. When we had our big wave of inflation 5 years ago, the asset owners recovered, if they ever suffered at all. They're the ones on the upper branch of the K, and the middle class and lower class that do not own assets, they were not able to recover, and inflation makes their standard of living sink lower. Where we're at today is that the top 10% of U.S. earners now account for fully half of all U.S. spending. Well, how much time do you have, if you haven't yet? How much time do you have left to build your portfolio to make sure your trajectory has you on the upper branch of the K, not the lower branch? 5 years. You only have 5 years left to get rich. All right, now that's not my answer, but that's what Andre G says. And I like some of his material, and I don't know if I'm saying Andre's name correctly, but according to him, the reason that you only have 5 years left to move economic lines, trajectories, to move from the K's lower branch to the upper branch is because of AI. You've got 5 years to learn a skill, start a business, or invest in real estate. The reason why is that upward mobility comes from finding efficiencies where you can make things better. But artificial intelligence makes things so much faster and more efficient, so that gap between the way things are right now and the way they will be in the future is going to close. AI compresses that gap to almost zero because when everyone can use AI to build websites, write code, analyze markets, automate workflows, whatever it is because it becomes really easy for anyone to do anything, and it becomes a lot harder to move from the bottom of the K to the top. So for those at the bottom, there are fewer inefficiencies to solve and get ahead. And this is why the saying, the rich get richer and the poor get poorer, has the propensity to speed up. So what can you do? I've described elsewhere about how stocks are not a wealth building tool. They're a wealth preservation tool if you already have wealth. Stock price to earnings ratios are bloated. It's good to select an asset or business that's hard to be replaced by AI and then get good at that thing, like HVAC, plumbing, pest control, electrical, roofing, masonry, or investing in real estate. Be in a niche that AI is going to have a hard time replacing. Just buy some rental houses. And here at GRE, we talk about optimizing the 5 ways that you're paid all the time. Buyers who are waiting for 5% mortgage rates, they're a little like people who refuse to buy gas at $4 because they remember $2. Okay, those days are not coming back. The market rewards action, not nostalgia. Actually, you can get 5% mortgage rates today through our GRE investment coaches because we know the builders that are buying them down to that level for you. Now, do you realize that even with zero appreciation and zero cash flow on a property, you're probably still going to win bigger than stocks in their average returns of 10%. That's right, even if you get zero appreciation and zero cash flow on a property, because with a historic average from your ROA, from your tax benefits, and inflation profiting alone, that's a 14% total return just using today's mortgage and inflation rates. A 14% return, even with zero appreciation or cash flow, you're probably going to have more than zero from those. This is why we do what we do here. And you're owning your own deal, your own rental property, and you don't have to be the manager. I'm talking about your own and emphasizing that because a lot of investors got burnt recently because they said, oh, I'm going to invest in this influencer's deal. He's pooling all this money together for a deal. Well, instead of that, you can invest in and control your own deal without having to be the day-to-day manager. Those that bought property through our GRE marketplace with our coaching a few years ago, they are rich today. We had a number of those listeners come right here on the show last year and join me for an episode. And you heard some of them say, here is what my life is like now. They got on the upper branch of the K. They turned Get Rich Education into Got Rich Education. And it's not just for beginners. We also have listeners that booked a free coaching session with us and they gave real estate another shot after their first attempt at real estate investing failed. And that's because here they got a coherent strategy from a GRE investment coach, and then they got the outcome. It's actually pretty straightforward. Here's how it works. Our coaching actually understands this business because they work with investors like you every single day, and we are investors ourselves. What they do is they sit down with you, probably virtually, understand your situation, your goals, your timeline, where you're at financially, what your preferences are, what your concerns are, and they ask you the right questions. They listen, and then they show you what's actually possible given your specific situation. A big difference between what we do and what a lot of others in the business do is that we are focused on your big picture strategy. See, we're not attached to any one market. Take local agents and local operators. Now, those people can be helpful, but they're clearly incentivized to have you buy whatever their product in their geographic market is. Well, our GRE investment coaching doesn't have that conflict of interest, and that's why, for free, our followers have such a good success rate in making sure they occupy the upper branch of that K. To find what's best for you, we'll walk you through different markets, different property types, and different strategies depending on what makes sense for your situation, and it's truly free. There's no weird pleading to have you do something else. We don't try to sell you some paid coaching program or anything else like that. In fact, if you want to buy something from GRE, you simply cannot do it because we don't even have anything for sale. In almost any other industry, you would have to pay to talk to someone this knowledgeable, but you'll know more when you hang up than when you called. So if you're ready to add real income-producing property to your portfolio, that's exactly where we can help. But it's more than that. If you want, come away with a plan to retire in 5 to 10 years because it's about a total strategy. You are cordially invited. You can book a free coaching call at greinvestmentcoach.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.